Good morning, everybody, and welcome to today's presentation. Just a couple of housekeeping things just as we begin. If you wanted to just put yourselves on mute as the presentation's going on, and then feel free, you could unmute yourself to ask any questions that you might have. Or if you feel more comfortable and want to use a text chat, you could do that, and I'll watch for those questions and I'll bring them to Stacey. So you're more than welcome to use that. So I am just going to do a brief introduction here. So growing up in an entrepreneur family, Stacey learned that education and business support is important to planning your future. Her dad's retirement was in business, and when that business didn't survive the changes in the economy, neither did his retirement plan. The integral part of Stacey's past is a key factor to ensure her clients are educated with the options to create a successful outcome. Stacey's 17 years as a financial advisor and her 25 years working in the family business has led her to working specifically with business owners. She's discovered that the years of 2020 and 2021 have changed the way many businesses operate. Employee retention and attraction is more important than ever. Having an employee benefit solution that fits a company culture and keeps the bottom line intact is a must to stay competitive. Stacey is a member of the Canadian Group Insurance Brokers and helps many business owners with their employee benefits and life insurance needs, especially in the corporate space. She's married to her best friend and partner, John, and together they have 3 beautiful daughters with families of their own. She spends her spare time traveling when she's able to and loves biking and hiking. She loves sharing her life experiences with groups like Elizabeth Fry Toronto to support women who value her positive attitude and encouraging words. And Stacey can be reached at, and I'll put her email address in the text chat too. So I wanted to welcome our guest speaker today, Stacey. Stacey, sorry, am I saying the Aarssen?
It's Aarssen, just like I'm
Aarssen, sorry.
I started a fire.
Awesome. So thank you so much for coming today. We really appreciate you talking about the needs for this.
Thanks, Lori. I really love the introduction and the invite.
When you take stuff, it makes you go to the bathroom more.
Oh, I'm just going to put a mute on here. Sorry. Okay, go ahead.
All right, so I need to share my screen. Make sure I share the right screen. Can you see that?
Yeah, we can see it.
Excellent. Okay, let's remove that. So that's my company name, and Benefits Redesigned. Now we're going to talk about employee benefits 101. So an employee benefit plan is a promise made by employer to the employees. This can become in many ways, and every situation is unique, and so should the benefit plan. Your company's company dynamics and demographics and situation will affect which plan is best for you. And I've just put a little outline. We're going to talk a little bit about me, benefits, basics, what type of plan, how to start, discovery, and a few options, EAP, and questions. If someone has a question throughout, I'd probably like to address it, because if you're thinking of it, maybe someone else is, and it can really add value to others. So just please put your hand up and Lori can let me know. As Lori mentioned, I came from an entrepreneurial family. My dad, started working with my dad at the age of 12. So entrepreneurship has been a very integral part of my business. And I've worked with my husband for 17 years, and we primarily work with small business owners and entrepreneurs as our client base. So employee benefits is really an important piece to the bottom line of any business. And I feel it's important to understand what options are out there. Now, what is an employee benefit plan? It's a group benefit plan is a promise made by the employer to their employees. Basically, that's all it is. This promise can include many things. It can include life insurance, your dental, massage, those type of things, and employee assistant plan. It could be a big piece of that as well. Well, there's 3 components of every benefit plan. And so there's insurance, reimbursement, and administration. The insurance portion is the life insurance, catastrophic. So life insurance, it's usually pooled life insurance for catastrophic reasons, such as like unexpected death or a big disability claim. And that's where I find employee benefits are misunderstood. They think in all of the whole packages is really a big risk, but it's really the life insurance, travel insurance, critical illness that are more types of insurance. The everyday in and out, the reimbursement of your medical, dental, drugs, those aren't really high risk factors. Like you're not going to die if you don't go to the dentist. So a lot of times you're paying a premium on something that might be really not a high risk. It's basically a money in, money out. And the third component of every plan is, of course, the administration fee for professional management includes like the adjudication of any claims and the employee records and billings and employee communications when they have questions or things like that. How do we start if you're a new business, a startup, or even if you're in business and you've been in business a long time? Where do we start with employee benefits? And in my philosophy with everything is discovery, is asking questions. Where are we? And these are some of the things that I talk about with someone is, why do you want to put a plan in place? Is it, if you're a startup and you don't have much income yet, but you think you need an employee benefits plan, maybe it's not the right time, because it's all about a cost benefit analysis and what risk or what does it cost you? So why do you want to put one in place? What type of business do you have? Do you have a high risk business? For example, something in the construction fields, any of the construction that you're climbing up ladders, or do you have an IT company that you're sitting at a computer all day? Because that can factor into what type of benefit plan you're going to have. How many employees do you have? Do you have just yourself? Or do you have like 100 employees? So, or more, like how many employees do you have? And the next thing is really important is, what is the demographic of your employees? If you have a group of 30-year-olds versus a group of 50-year-olds, or even a mix, the group of in their 50s are going to want something more different than the group in their 30s. The group in the 50s might have some drug costs that, the maintenance drugs that they need. They might have other issues going on, like eyewear. I'm in my 50s, physiotherapy, things like that. Understanding that demographic is really important piece to figuring out what is best for those employees. What is your budget? So many times I work with people and they say they want a benefit plan. And so we go over things and they tell me, we go through these questions, and then I ask them, what is their budget? And it's like, but they don't know. But you have a budget if you're buying a car or you're going on a trip. So having a budget to understand what can your company afford on a monthly basis to spend on this employee benefit plan. What do your employees value the most? So do they value having the drug plan? Do they value having massage therapy, dental? There's EAP. Mental health is huge right now. So understanding what your employees value is a key factor. What do you base the decision on? Price or value? Again, you want the cheapest plan, or do you want the plan that's going to drive the most value to your employees? And how do you view employee benefits as it relates to employee hiring and retention? And as part of the overall compensation package, where are you trying to position yourself? In employee retention, I have stories like employee retention and attracting employees. I have a client, and she is in the food industry and she has a franchise, and she's having a heck of a time trying to get management and employees to work in her location. And she's top 10 in Canada. So she's got a very busy restaurant franchise, and she has to work a lot of hours. So part of a compensation plan might also be, I have another client that he has over 60 employees, and he has a lot of the demographic is a lot in their 30s, 20s and 30s. He spends about $1,500 a month to stock his kitchen. So with different drinks and nuts and bars and just snacks for them. So that's a, it's sometimes it's not always just about health benefits. So that's just to give you an example of what you can do. Have you ever considered a specialty carrier? So we're going to go through this because I'm going to talk about specialty carriers. And there's four main areas of options. And the first one I'm going to talk about is a health spending account. I see there's a question. Is there a question? Oh, no. Okay.
Judy just put her contact information in there.
Okay. Health spending account. If you haven't heard of a health spending account, it can be a great way for startups, or even I have clients with over 30 employees just using a straight health spending account. It's basically a simple way to offer all employees an equal amount of money to spend on healthcare needs. And there can be add-ons like your life insurance and disability and things like that. My next slide, I'm going to just play this 2-minute video because health spending account, especially if you're an entrepreneur and your startup, this might be a great tool for you to understand how they work.
But we can't hear anything. I don't know. Was there a?
Oh, you can't hear it.
I think you have to connect to your, I did this once before and they told me how to do it now. Of course, it was such a while ago. You have to use your computer to.
You know what? It's okay.
Yeah.
I will just talk about it. I will just talk about it.
Yeah.
Yeah.
Okay.
I was wondering about that because I can hear it fine, but you guys can't. So I apologize. So basically a healthcare spending account is like a bucket. I'm happy to share this video with you, and then we can share it. You can share it with whoever wants to see it. But a healthcare spending account is basically the employer chooses the amount of money, a bucket of money to allocate to healthcare costs. And through that bucket of money, you can use it then for any CRA approved expense. And that includes like dental, drugs, all your paramedicals, which is your massage therapy, your physiotherapy. And so that it's like I said here, it's a tax deduction for the employer and a tax-free benefit for the employee. So through the year, if you pre-fund one of these buckets, if you only, let's say you pre-fund it at $2,400 a year and you only use $1,200, then there's $1,200 left for the next year. And if you don't use it after the next year, it goes back to you. So it's a great way for you to put a healthcare plan in place at a predetermined amount of money. So it keeps the cost equal. You know what you're going to put into it, and there's not going to be any surprises. So for example, my eyeglasses, they're like, $1,000. I can pre-plan to put into my healthcare spending account what I'm going to use for the year. So my physio or massage, it all goes through my health spending account, and it's a great way. I'll just go back to the slide. It's a great way to, like I said, for startups or even small business, or if you have 1 or 2 employees, to put a healthcare plan in place that is a tax deduction for the business and a tax-free benefit to the employee. I'm happy to, like I said, and any marketing material you see from suppliers, it's just because they have great marketing pieces, and I'm brokered with many. I just use certain pieces because it's they have they did the video, but obviously I didn't check to see that it worked at my end, so apologize for that. The next type of model is your traditional model, which I would believe most of the people I talk to understand. And this is offered by insurance companies like Manulife, Canalife, Sun Life. And these type of plans are based on a target loss ratio, depending on the size and experience of your individual group. And most insurers want you to be in business for at least 6 months before you start one. And they also, the minimum, there's a couple companies that offer as low as 2 employees. So the average is, you want at least 5 or 6 employees for these type of plans. And the reason why people want to do these plans is because that's all they know. And that's what they're used to. And it can be good, it can be bad. It just depends on the experience in your individual group. So examples, all traditional models too, it's mandatory that they have life insurance on them, a minimum of 25,000. And then they have your drugs and your paramedicals and any EAPs or wellness. So I'm going to actually share with you an example of a basic plan, because this is part, like we're doing an education piece. So if you were to go and to maybe you have one of these in place, or you want to get like, for example, a Manulife traditional plan. You're used to a traditional plan, you had it through university, or you worked in a corporate setting and they offered a big Sun Life or Canada Life plan. So you're used to this type of plan. So here's an example. If I had a virgin group, meaning they never had any benefits in place, and I wanted to get, and they don't know what, nobody usually understands what the offerings are. So we start off with just a basic type of setup. The minimum type of insurance is 25,000. So I have 2 different areas, a basic and an alternative, just to send out to market. And it reduces at age 65 by 50%. Non-evidence maximum, to understand what that means, is it means that if anybody wants more than $25,000 worth of life insurance, they have to put in an application for the extended. So non-evidence means you don't have to share any of your health history with this minimum of 25,000. And this is why this can be really good for a new hire that maybe has a high, like they have a lot of health risks. They automatically get the 25,000 no matter what. This is one advantage of a traditional plan. So life insurance goes to age 71. Dependent life is 5,000. Child life 2,500. And so now the drugs portion. Now on this, we put, I think somebody's on there. Oh, the drug maximum is unlimited on this illustration. Now the deductible is equal to the dispensing fee. Here's a tidbit on dispensing fees. So if you do have a plan, or you're looking to set up a plan, the dispensing fee can be very different from different pharmacies. So you could go to Costco, which is supposed to be the lowest in the industry, or even Pocket Pills is another one. Or you could go to a different kind of whatever the Shoppers, or their dispensing fee could be quite a bit higher. So if you're paying for the dispensing fee out of pocket, this is something that you want to understand yourself, because you could save $5 or $6 per prescription. Coinsurance means that's how much. So at 80%, the employee would have to pay 20% out of pocket. So as you can see, the basic and alternative, we put 100 versus 80. Plan type, pay direct card. So there's a card. Mandatory generic. In drugs, there's generic or there's name brand. So it can cost a lot more to offer name brand drugs, but it can be added, and it can sometimes there's I have a client that the employee had to go through a protocol to actually get this name brand drug approved through their plan. So that's just something to be aware of. Lifestyle, so they have different lifestyle things that you can add: fertility, smoking, vaccines requested. Major medical. So again, this is more of the other portion, which would be your paramedicals and things like that. So paramedicals are what everybody loves: your massage and your physio and things like that. So at this plan, we've got it in 80 or 100, $300 per practitioner. Now this is just an example. This can be changed. So when we send this out to market and we get quotes, I have one client I'm working with right now, and they want to see what $500 worth of per practitioner, because they go to a lot of massage and physio. So they felt 300 wasn't enough. And so you can adjust that. Another thing to be aware of, vision on these type of plans can be very costly. So the premium cost for vision could be not really worth it if you look at the whole scheme of things. If you have employees, a lot of employees without glasses, it might be option to add a health spending account to one of these plans, or these type of plans also offer like a cost plus, which is a whole other discussion, but these are type of things that you want to be aware of. Dental care, as this one, we're showing $1,000 at 80%. Recall every 9 months, so you can go back every 9 months. Again, these can all affect the pricing. So what will happen with this type, it will go to market, we get pricing back from all the different carriers, being Manulife, Empire, Sun Life. It could come back from Blue Cross, and depending on how their experience is, they'll price it out differently. So then what happens is the employer then will go back and let's change the recall to 12 months, or we'll change different things because maybe the cost was too much, or they want to increase things or things like that. So these type of plans can be adjusted. And what is really important factor on these is the renewal. The renewal is usually every 12 months, and at the renewal, they're going to price it based on your experience. So of usage. So for example, I have a client right now, and they've used 136% of their plan. So their increase was about 35%. So that means they're going to pay 35% more the next year just based on their experience. So it's really, this can be, it can be like a bombshell if you're not really aware of what pricing is. So it's not always best to go with the lowest cost based on just experience, because then if they're low, they could be trying to buy your business. And the next type of option that we have is called administrative services only, ASO. And a lot of people are not aware of these type of models, mainly because they were usually only offered to big groups of like 500 or more. But in the market today, there's called third-party administrators that offer these type of models. And when I said at the beginning, have you considered alternative model, a solution? The health spending account is one. This budgeted administrative services only is another option. It could maintain cost and flexibility and full transparency. So an administrative service plan is merely an alternative way for employers to fund their employee group plan, and it's using funding models that they have from other experience of their group they have. And essentially, the employer pays one large monthly check to the third-party administrator, and the benefits providers pays out small checks, small refunds to all the employees. So if you think of it this way, ASO model, what would happen is the employer would pay, let's say, $5,000 a month for this group of employees. That could be 10 or 15. Exact amount. Let's just $5,000 a month. And let's say the claims that went in that month for those employees was $3,500. Well, there would be leftover of $1,500. So, but then the next month they spent $7,000 on benefits. So they would kind of go in the hole. The next month they would use less. So over a course of the year, they actually are ahead by about $1,000. So this way, this model, the cost to run one of these is less than a traditional model, from the insurance carriers, and the employer is ahead. There could be risk factors in this, though. I don't like to set these type of plans up unless a group has experience. So experience comes from either a traditional model or what I'm going to talk about next, a pooled plan. So these type of model, this ASO though, can be beneficial to a lot of employers, and it reduces the cost, because the cost that goes out to the traditional insurance carriers can be as much as 30%, where 30 to 35%, where on these type of models, it can be to 20 to 25%. So just the administrative cost. So that alone can save the employer quite a bit of money. The next type of plan that we have in place is called a pooled plan. And you might be familiar with some of these. They're like an association plan. And might be familiar with the Chamber of Commerce. Chamber of Commerce offers these type of pooled plan. And it can be a great starting point for a new business. And because the rates are constant, they usually just go up about 6%, which is like the rate of inflation. And it's based on a bigger pool. So if we think back on the traditional model, the rates they give you is based on the experience of your individual group. So if you have a group of 10 employees, and let's say you hire someone and then their spouse has MS. Well, that and their drug costs, let's say on that traditional model, let's say you have unlimited drugs, and then what would happen is your experience for that, your rates will probably go up on that traditional model the following year. Where on a pooled plan, they're basing that experience over, it could be like, for example, I'm going to show an example from Blue Cross. It's based on hundreds and thousands of employees across Canada. So you can see how you're going to have employees that are really healthy, and maybe ones that are not healthy. So the experience gets washed throughout the many members, and that's where it can be more advantageous, so to say, especially for a startup. So there are some rules and guidelines for a lot of these association plans. And like I said, I'm sharing Blue Cross because this one is one that's has been it's a really decent plan. So it insures up to only 10 lives. So if you have more than 10 lives starting in with one of these plans, you couldn't qualify for that. But you can grow up to 25 without them taking it away from you. That's because a lot of companies that they have 8 or 10 employees, and they put something like this in place, and then the next 3 years they grow to 25. But at that time, it's really worth it to look at alternative plans anyways. Perhaps maybe your experience is good and you want to go to a traditional plan, or maybe you're ready for an ASO type plan. So it could be that. The business does have to have a minimum of 6 months. It states it here. They do have to be actively at work. One thing to make note of any employee plans is contract workers are not considered employees. If they're not getting a paycheck from you with T4 salary, if they're not getting a T4 from you, then they're not eligible on really any plan. Contract employees then they should get their own individual, maybe health spending account. So that's a big note that I want to address, is that contract employees, unless they're getting a T4 income, they're not really considered employees. On these type of plans too, like a minimum of full 20 hours a week is stipulated, mandatory. So participation basis is mandatory. That means that nobody can opt out. Now they could, so that with that, this is traditional on any traditional model as well. Mandatory means they have to take the life portion. They can opt out of the health portion, being the dental and drugs, because maybe they have a spouse that has some. So the mandatory is definitely the life insurance. There's waiting period. The normal waiting period is 3 months. I usually recommend, but if someone's wanting to hire someone, you can waive that. One thing that I want to really highlight too is late entrance. And this can be really important factor with this type of model and in the traditional. Late entrance can be a big risk factor to the employer if they're not handled appropriately. Normally, when you hire someone, you have to put them on the benefit plan if you have a 3-month waiting period, to put them on by 3 months. And if not, that could be a risk for the employer. And here's an example. Just recently, in the last couple of years, there was a company in Ontario. I think it was in the construction business, and they hired this gentleman, and the plan administrator, being the person who takes care of the employee benefits, gave him the enrollment form. followed up, called, emailed several times. Well, 6 months after he was hired, he unfortunately got in a bad car accident and was paralyzed. And so there was disability offered on this insurance plan. And so he got a lawyer and he sued the insurance carrier, he sued the employer and the advisor. And the reason why he sued the advisor, because me as an advisor, I need to make sure that the employer or the plan administrator is up to date on this late entrant, this component. So I'm spending time there just to highlight that there's many components that are risk and could, what I like to do is to avoid litigation. So that's what we need to do, is avoid litigation in some of these circumstances as well, because it could be caused by the employee benefits plan. So there's normally, these are just a few other small things that to highlight, but when we look at the plan design, it's very similar. Just a second, let's take a look in the water. It's very similar to the insured plan, from the insurance carriers. There's like I said, there's a mandatory insurance piece for everyone. As you can see, they have two plan designs. The insurance is different. On the essential, they do offer disability as well, but prescription drugs, you can see there's a difference. There's a 3,000 to 5,000. Diabetic supplies. I have a client, they were really, they got this plan because it covered not only the 3,000 but extra 1,000 in diabetic, and her husband is a diabetic and needs different supplies. So that was a good feature. Extended health, again, they have similar guidelines as well, 500 and 600. These ambulance. The other thing was hospitalization. I wanted to make a note about this as well. Eye exams are there again, but hospitalization, as you can see, there's it's covering $200 per semi-private. What I want to make note is have you been to a hospital lately? And most hospital rooms are semi-private. And also the other thing is, if there's no semi-private rooms available, they're going to put you in the room that they can put you in. So sometimes adding semi-private to like a plan, it's mandatory on this. You can't change these plans, but on a traditional plan, it might not be worth to have these days. It's just, I'm just showing you this, what a pooled plan might look like. One thing with a pooled plan, how this is laid out, there's no changes. The $500 per practitioner, that we can't change that unless you go up to the essential. What is the other thing is you can get pricing on this like within like minutes, because it's going to be based on the age of your employees and how many employees you have, and it's the pricing on these type of plans is all set out, where on the other one, the traditional, it goes to all the carriers and they price it out accordingly, and by adding different things it can make big or little changes. Other things that are available on these type of plans, the dental care, of course, is similar again to the traditional. Travel insurance. Travel insurance is another big risk component, that inside travel insurance, there's stability periods that people need to understand on employee benefits. And what that means is stability period is how long has it been since, so the stability period is, the average is 6 months. So that means if you've changed any medications, being increases, decreases, additions or deletions, medication, that will change your stability period. So here's an example. Let's say you're planning to go to Florida next week, and you go to the doctor today, and let's say you're on high blood pressure medication. And the doctor says, oh, you're doing really well. You've lost some weight. You're exercising. I'm going to reduce your blood pressure. Your blood pressure is really good. I'm going to reduce your medication. So you're all excited. And you because you got your blood pressure medication reduced because you're, getting healthier and things like that. And then, so next week you go to Florida and you go and you're golfing, and let's say you have a heart attack. And so oh, good, you have your travel insurance, you're okay, you go to the hospital. They deny the claim. And they deny the claim because your medication changed. You had a decrease in your medication, even though you thought it was a good thing. They want stability of that new medication for 6 months. So this is a big factor, and where it could be a lawsuit for the employer if the employees are not aware of all these little nuances, which is that they need to be aware of, and could cause a risk for the employer. But that's just a side note, because people are traveling too. So I wanted to make sure that you're aware of that stability period in travel insurance, because I'm a big advocate for that. Long-term disability is offered through this type of plan on their more advanced one, the essential it calls. Disability, I really suggest to put on an employee benefit plan. And the reason being is it's like paycheck insurance. So and it's usually so much more cost effective than having an individual disability plan. So, and there's a non-evidence maximum. So remember how I spoke about the non-evidence maximum? It's a really important feature on a disability in a group plan, because they will have a non-evidence maximum. They don't list it here, but let's say, oh, they do, $2,000. So the $2,000 is non-evidence. So that means that somebody could get up to $2,000 without any medical questionnaire. So that person could have, let's say, bad leg, because disability not only covers you for health, but for injuries. So if you have past reasons with a disability with your leg or something, in an individual plan, you wouldn't be covered for perhaps a leg, but on a disability and an employee benefits, you're going to be covered up to $2,000. So when they say the maximum monthly benefit is $4,000, that means if you want $4,000, you're going to have to put in a health questionnaire. It's health, and just to ensure that you can get the $4,000. So I highly recommend, if you're doing an employee benefits, it might be a good piece to add on. The other thing is it should be paid by the employees at 100%, because in that way, so if you look at it, you're not paying for it, but the employees are. And if you started out that way, and it's hard to add it in after, but the reason they have the employees pay for it is because the employees need to receive that benefit tax-free. Because if the employer's paying for it, then there needs to be a taxable benefit, a taxable deduction for the employee. But if the employee's paying for it, then if they were to go on disability, they'll receive that $2,000 tax-free to them, because the government wants the money, the tax either way, either on the premium or on the benefit. So just think of it that way. Government wants, CRA wants tax some way, so somebody has to pay it. And it's better for the employee to receive that $2,000 tax-free. So, because depending on their taxable what tax rate they're at, it could be a big difference from what they receive. This is just more add-ons that you can add on to this type of pool plan. If you recall me saying in the traditional, you could add on a health spending account. That might be an option. Why would you add a health spending account to this type of plan? Well, it could cover the deductible, the 20% that's not covered. It could cover for things that aren't covered. It could go towards braces, more expensive glasses. It can go for all those type of things. Another option that's available on these type of plans is critical illness. And I recommend actually adding critical illness to a lot of plans if you're putting one in. And the reason being is we all know someone that's had cancer, right? 1 in 2 Canadians are going to get cancer in their lifetime. So, and cancer covers, the main things are critical illness covers cancer is 70% of claims, heart attack, stroke, and sometimes depending on the type of plan, it could be up to 25 different illnesses. But a lot of the ones that are offered through employee benefits are the 4 core, which is heart attack, stroke, cancer, and I think it's another one to do with the heart. I have to clarify that for sure, but cancer is the number one. And of course, you can add in extra life insurance for employees and things like that, and best doctors, optional maximum doctor's visits. You can add all those things in. So that, again, those would just be extra cost to the employer when adding those things in. Another thing that is more new in industry. They're called wellness plans, and these are add-on things that you can do, or you could actually just offer a wellness plan with maybe a health spending account or something. And some plans have health spending account wellness, and they'll give like, let's say $1,000 for health spending account and $1,000 for wellness. So it's basically a separate category, and really the benefit of these are to enhance personal health. What's covered are things like golf memberships, maybe your kids' hockey, yoga, meditation, things that maybe aren't covered on the traditional plans or health spending account. So it's things for to help maintain the employee, to maintain a healthy lifestyle. So one thing to take note, and so here's some other examples: fitness equipment, childcare, health, like professional services, health assessments that might not be covered, gym memberships, naturopathic vitamins, like those aren't covered under any type of health spending account, or they're not CRA approved vitamins, unfortunately, even though they're going to be better for us. One thing to note, though, in wellness is there is a T4, so it is a taxable benefit to the employee. So on a health spending account, as I mentioned, it's a tax-free benefit. This one there would be a taxable. They would have to pay taxes on that benefit. So if you gave them $1,000 and their tax rate is at 30%, then they'd have to pay the tax on that $1,000. But like I said, it's a great way for especially groups that have a lot of millennials, maybe perhaps in their team. And the other component that is really good to add to any plan right now are EAP. And so EAP is an employee assistance program. And it's basically a network for the employee to have when any mental health crisis. It's more of a mental health crisis that happens. And as we know, it's been huge. I have a friend that is a social worker, and she was sharing with me the journey of her hairdresser, and through the last 2 years. And this hairdresser, she had to quit work. She's a single mom of 4 children, and it brought her to mental breakdown. And so she was telling me she had to move recently, and she was helping her out. And she says, this woman never wants help or anything. And, so these type of plans can help people. Unfortunately, being a hairdresser, perhaps she didn't work with someone that does offer employee benefits, but this type of, anxiety, depression, stress management, if they've lost someone, personal issue, like any personal issues, addictive behavior, anger management, sleep hygiene. So they can tap into these EAP programs, even like legal and financial planning. It's a really important component that I've had more businesses reach out and ask about, and it can be added. There's one thing to note, though, there's different options. Like there's different carriers that have different solutions, and they base it on different things. For example, one company offers EAP, and it's based on their network, and it's a large EAP provider, and they offer great things. But another provider offers, and you have to work with people in their network, and you only get so many hours. Where another provider offers their social workers based on they take it through like a personality. You have to answer all these questions, so they'll match someone up that's more liable to be in the same, they have the same ethnic background, they have the same philosophies and integrity. So they'll match them up, and that person then can actually go on and they can actually do support outside of it on, they can connect with them individually after. So there again, it's just doing the discovery to what's important to the employer can really be important factor to which EAP program you offer, because like I said, they're not always the same. Every situation is different. And I'm gonna just wrap up with a summary here to keep us on time, and to, you know, if you have questions. So a group benefits plan is a promise made by employer to their employees. Basically, that's what it is. What type of plan? What type of business do you have? Depending on the experience of the employee benefit, can decipher which plan would be best. As you can see, there's many different options, and depends on your business and your demographics and your experience, where we might look. Discovery, like I said, it's really important to understand where you are, and for me as an advisor to understand where you are, so then I can help direct to be where you need to go. So just think of somebody like myself as a quarterback and finding out which direction to go. So the options, like there's a health spending account, there's the traditional model, which is, like I said, through the carriers, all the life insurance carriers like Manulife and Sun Life, and then there's the ASO plans, the administrative services plans, and then there's pooled plans, as we mentioned, that I shared with you from Blue Cross. But also there's hybrid plans, which I forgot to put on here, but hybrid is like, you could have a bit of a health spending account with a traditional model, or with the ASO plan, or you could have a pool plan, and then on the pool plan, then have a separate EAP program as well to add on. Or so there's hybrid, meaning it's put together just for you. And it can be more beneficial to, you know, for you and your employees. Wellness plans, like I said, are more of a newer type of offering to employees that is a taxable benefit to them. But hey, like, you'd be the hero if you're, you know, somebody's talking, yeah, my employer's playing for little Jimmy's hockey for the season or something, you know. That can be like a boost to you as the employer, you know, because things like that could be covered. EAP, as I mentioned, not all EAP providers are the same. So it's important to do a little homework to understand what could be the best option for you and your employees. And yeah, and then now do we have any questions?
So if anybody has any questions, please feel free. You could take yourselves off mute. You can ask the questions there. There's no questions right now in the chat.
No?
No. Judy, do you have a question?
Yeah, Stacey, great presentation, by the way. As you all know, I know Stacey, but not terribly well yet. So this has been a great opportunity for me to get to know her much better. And I know that she has such insights into these plans. But I guess what I'm curious about is, how do you see things changing over the next few years? You know, with the people that aren't necessarily looking to be employed as long as somebody like myself who stays forever. Are you seeing a lot of changes where they have a plan that 8 years from now, 10 years from now is going to change drastically, and they're going to lose maybe what they had and maybe not be able to replace it?
Yeah, great question. Yes, right now drug costs are definitely on the rise. One thing that's in my discussions, I shared with you, I'm part of CGIB, which is Canadian Group Insurance Brokers Association, and there's even discussions about disability being taken away, like taking off the market. So because of the claims experience. So you could see a lot more higher costs in putting these plans together, in my projection, for sure.
Okay.
Yeah.
Thanks, Stacey, because I mean, I'm way too old. Nobody's going to insure me anymore. But I better not get a critical illness, because it's not going to be good. But no, it is good to know, though, what's going to happen in the future, especially with, you know, companies that are forming. You know, what should they be looking at? So thank you very much for that.
But one thing too, like you said, with older, like there are long-term care insurance, like they're more of a home care insurance available. Just an FYI, they're called home care insurance. Yeah.
Yeah.
that's been developed, and yeah. Thanks, Judy.
Oh, no problem. No problem.
Yeah. Any other questions out there?
Hi, I'm Donna.
Hey, Donna.
Um, I work in the life insurance industry, and briefly, I had worked with a company that was doing group plans, and I know that it's very detrimental and it increases the cost when there is a small business and one member gets all these expenses. You know, like I think you were mentioning diabetic or whatever, and things like that, and that's really going to be a big pain point for a small business when you know your premiums go up because of one member who um, using up a lot of benefits, right?
Yeah.
Is there a solution or things like that? Like if you're the business owner, you don't know that you're hiring this employee, something happens, and then they're like, your premiums keep going up and up because of people using the expensive benefits.
Exactly, and that's where it would be really good for that employer to do really an analysis and look at other options, because maybe they're better suited if there's under 10 to look at a pooled plan. The other thing is manipulating the plan to put maximum levels for drugs. Like, so for example, if maybe they have unlimited drugs and maybe they need to put a maximum of $3,000, they need to maybe reduce things like that. The other thing that's maybe you're not aware of is Trillium is available to all Ontario residents. Trillium is a drug plan that can, if somebody has a high cost drug, they could apply to Trillium and they put a deductible based on your household income. So for example, if somebody has a drug that's like $20,000 a year and maybe their deductible is $2,000, so that way then maybe they use the employer's benefits up to $3,000, they do the deduct, maybe the employer even helps them pay for the deductible, but then the rest is paid for by Trillium. And a lot of people aren't aware of Trillium. You can just Google it and it will come up. It's like I said, it's an Ontario drug benefit plan. So there's a lot of different things that employer could be doing and should be doing with whoever they're working with. That's what I would recommend.
That's for the employee if their income is low enough, right?
Yeah, but even if it's high, like I have a client that I think he's over 250 grand a year, and because of the cost of his drug, it was worth it for them to go on Trillium. Because even if they're paying out 5 or 6 grand and their drug is 30, there's 15 grand, right? So I would go through the process of putting in the application and seeing where you go with Trillium before you just kibosh it.
Stacey, my sister and her husband, her late husband, was extremely diabetic, and the drugs to keep him alive were very expensive. And even though he had a phenomenal drug plan with his employer, they still had Trillium to back it up.
Right. Yeah. I have a client right now that we're looking at benefits, and she's on Stellara, which is for Crohn's. And I think it's 75 grand a year.
Yeah.
So we're looking at, because she's only got 2 employees, Manulife and Empire are the only 2 that we'll look at with 2. Manulife states right in there, they don't cover Stellara in their drug because it's more of a name brand or whatever. So we're okay to go get drugs because I don't want to put a plan in place if this, because she is on Trillium, or she's not on Trillium, but Stellara is paying for it. So it's a workaround to make sure that this plan it's not going to go offside because of this Stellara. So there is a lot of planning that can be done, but I'm about there's a solution. Like how do we work around, and being part of CGIB, it's a network of over 250 group advisors. And so if there's an issue, then I have a team, like I have a team too with my my MGA, which is my group, is another group thing that I belong to. So there's always a workaround. Sorry. Go ahead, Donna. Sorry.
That Judy was mentioning earlier, like with the gig economy and people working more independently now, like is there a good provider that's is like Blue Cross like a really cost effective, what do you think is a good plan?
Yeah, like, there's also like, there's others association plans, but, Blue Cross is just one. Like because I'm a broker, so I have a client that she just switched, she had a Manulife plan, the traditional model, and we switched to a Blue Cross model, and she went from $700, there's just two on her group, and she went from 700 to 500. So, or even less, it was, I think she was almost paying 900. It almost was like a 40% savings based. Now that was at today's premium. So it's worth, I'm here to just, it's worth looking at other options, and let's widen our scope of what is available. So there's something for everyone.
That's why we need you, Stacey.
Thanks.
I'm
Thanks,
sorry I
Judy.
have to say goodbye to everybody. I have to duck off onto another call, but this was a pleasure to be on here today. Thank you so much for inviting me, Stacey.
Thanks for
Judy.
joining us.
Oh, no
Thanks, Judy.
problem. Thank you very much.
Does anybody else have any other questions and I did put Stacey's email up in the chat above in case you do have some questions, later on or something like that come up. But if there's no other questions, I just want to say thanks a lot, Stacey, for this, like a ton of information here. And I'm sure that, people have good information from you, and appreciate you coming in to talk about this kind of stuff with us today. When we're in the chat. Oh, thanks.
Yeah. Thanks so much for having me. And if anybody has any questions, just reach out, email. I'm happy to just answer a question. Like I want to make sure people know what they can do. So
Absolutely, for sure. No, that's great. So thank you once again, everybody, for joining us today. But thank you so much, Stacey. We really appreciate you coming in here, and maybe we can do this again sometime next year as well. We'd love to have you back.
I'd love to. Thanks a lot, Lori, for having me. All right.
No problem. Wishing you all a great day.
Have a great day. Thanks so much.
Bye.